With a strong support below and a cluster of technical resistance piling up above, we might be in for some powerful risk-to-reward swing trades ahead. In the previous episode, we outlined a detailed report on the current situation at hand and what to expect moving on. The major outtake of it was that the 1240 area on the Swedish OMXS30 index must hold for a substantial amount of time in order to not risk the worst case scenario at which the blindfolded global economy has been crashing down towards for much too long now, namely an economical depression. For let's be very clear about something. We are at a stage on the markets where the index moves individual stocks, or rather where herd emotions cause the moves. This is the typical reaction during euphorias and panics. Whatever the herd does now, the majority of stocks will copy regardless of any underlying fundamentals. The logic behind this is that no matter how well an individual company might be doing at the moment, if a depression were to emerge, there will be few people and companies around with money and demand enough to purchase their products and services. But before we get started with the technicals, do note that nothing in this video is financial advice. Everything I say is my own personal opinions only. Now, first of all, and as I outlined in the previous episode, we are likely in for a crazy ride, and I do expect continued volatility until further notice. Volatility is a typical reaction of uncertainty, and in terms of uncertainty, there is certainly no shortage for now. Given the uncertainty and emotional state of the market, no one can predict specific outcomes, especially since they are much too dependent on the corona development from here on. We can literally go either way depending on how the future plays out. If they were to find a record time vaccine, for example, prices will of course explode to the upside, at least in the short run. If things were to continue to worsen at this already exponential pace, then expect index prices to follow suit. In this sense, the job of a technician is simply to detect and determine the most likely outcome given the current market temperature and to prepare oneself accordingly. Hence, we will look for good risk-to-reward opportunities that stand a good likelihood of emerging whether we go bearish or bullish. So far, we have tested the ever-so-critical 1240 area once already at 1261, and I'm sure more tests are to be expected in a not-too-distant future. However, I do not expect this area to break without a fight. It is a very strong area of support, and the only likely way I see us going under it is with significant selling volumes. This could happen in two ways. Either we break through without retesting the support area via a massive panic sell-off, one worse than the ones we have yet experienced, and one that will simply sail through this 1240 support area level like a flaming meteor crashes through a glacier. Such case would very likely be the result of some particularly bad news. The other possibility is that we test the support a few times before we are able to come through. For do bear in mind that the more times a support or resistance level is tested, the weaker it gets. And the more times it tests it before breaking through, the more explosive the breakthrough movement will be as it accumulates more power for every time it bounces. This practically has to do with the fact that every bounce comes with either a new set of buyers or with previous buyers of that very level adding on to their positions with the conviction that the support is strong and the price should shoot upwards. But at some point there are no more buyers left, at least not in relation to sellers, thus causing the ratio between buyers and sellers to get skewed. This eventually unleashes a powerful selling reaction at which the previous buyers try to get out all at the same time. And the more the price declines, the more panicky and waterfalling a movement it creates. This is a great example of how technical analysis is a manifestation of herd psychology. A typical illustration of such a wild breakout is Bitcoin's 50% decline in 9 months throughout 2018. This plummet took place after Bitcoin had tested a $6,000 to $6,200 area no less than 8 times, each time weakening the support as there were eventually fewer and fewer buyers left, only sellers. However, if we were to break below the 1240 soon due to some really nasty pieces of news, I would still expect a retest of that very same area, which in that case would have turned into a resistance area per classical technical analysis. These retests are some sort of a standard praxis and would technically be an ideal spot to go short or to add on to any already existing short positions. On a quick note, if this video and this channel help you bring clarity to the markets, please like and subscribe. It helps the channel and makes sure more people can benefit from the same knowledge. In difficult times like these, we need to help each other out. This is my way of contributing. Now, we have an indecisive formation in the making. What first seemed to be an ugly and lopsided pennant quickly evolved into a rather symmetrically perfect pennant with contracting prices in the making. This one, however, failed to qualify technically due to a much too premature outbreak and since it only had 2 touches on the upside and downside respectively. Instead, it rather began to transform into something else and now shows clear tendencies of being a bear flag in the making. However, we still need another touch for this to be confirmed, and until then, this formation could very well be disqualified for something completely different yet again. However, if this bear flag were to be confirmed, or any other pattern, which in this case typically would account for a continuation pattern, prices would statistically be expected to go down, at least initially. The only problem with this is that it is very close to the critical and powerful 1240 support area. Thomas Polkowski talks about this phenomena in his classical book Getting Started in Chart Patterns, that one should be wary of taking outbreak positions near a support resistance level. And since the chances of breaking through this 1240 level without a fight is rather slim, a downwards breakout and rejection at this very area would be a more likely scenario, one that would then reverse upwards and hence technically turn into a false breakout. And given that false outbreaks tend to move aggressively in the opposite direction, a long at 1240 would statistically be an optimal play and one that I will be looking at taking myself, especially if we do get an aggressive initial downwards outbreak from the hopefully confirmed flag. Moves to the upside, however limited, are very much expected for several reasons and something I do count on. One such reason, of course, is because of the expected volatility ahead, combined with the fact that we may yet not be ready to go below the 1240 area. But apart from these, there is also a multitude of technical reasons which I will try to outline now in detail. Do note, however, that until the opposite has been proven, things are still very bearish and short-term price movements to the north don't necessarily at all have to be bullish per se. The prevalent trend is down and we are in the midst of a confirmed recession as it is. This fact is also confirmed on the weekly chart where we have our first bearish RSI channel confirmation in 9 years, since August 2011, albeit that one did prove to be a temporary dip, which was reconfirmed as bullish again a year and a half later. Having said that, here are the technicals in favor for a temporary move to the upside. 1. As mentioned in the previous episode, the notorious market behavior preceding a crash are drastic price plummets after a local or all-time high, which are typically followed by a rally to the upside, after which the real crash initiates. These are the nastiest of all bear traps as they happen fast and drastically, thus falsely lulling naive market participants into the false notion that the worst is over, just like key finance figures and media proclaimed in 2007. If you want to learn more about this, please watch the previous episode, The Coronavirus and the Market, linked to at the end of this episode. In these cases, prices usually rebound or coincide with the 0.5 fib or the 618 fib, not the 382 fib, before turning steeply and shooting downwards. It is after such a fib retracement that we should truly keep our guards up and prepare our short positions. And if such retracement were to happen in a few weeks' time, long enough to have caused severe damage on the economy on its own already, and without any light being visible at the end of the corona tunnel, then such Fibonacci levels would constitute an incredibly strong resistance and bearish admonition. 2. Even more beautifully aligned is the fact that both the 0.5 and 618 fibs, being measured from the previous low at the support zone at 1261, happen to perfectly coincide with previous support levels, whereof the 618 aligns with the stronger of the two. Both offer strong levels of resistance, and I have a hard time seeing them being broken unless some very bullish news is presented to propel it through. And when the public sentiment turns too positive at such a level, as it typically does, it might pay well to become a contrarian. The deceiving part of this, however, is that once prices were to rebound to those levels, even rational people who are prepared for it and who know it is a very likely bear trap in the making are subject to being lulled by the pleasant song of the siren from the upwards trend. I've fallen prey for that trick a million times myself. Our brains seem to be wired to only see whatever trend has been prevalent in the last couple of weeks. Anything before that is outside our field of vision. In accordance to Nobel Prize winner Daniel Kahneman's research, if the current trend is strongly bullish, our fast, intuitive and emotion-driven system 1 part of our brains tend to have a very difficult time in imagining and fathoming bearish candles and negative trends ahead at all. Such scenario would feel like science fiction, that is until they actually do happen, whereas things being bullish will in turn feel surreal. 3. Depending on when a rebound were to happen, given that it does occur roughly within a month's time, a touch on either of those fib levels may very well coincide with a touch of the EMA 50 on the daily, as it's steeply on its way down regardless, which on its own would constitute a resistance level. A test of the EMA 50 is very much expected at some point soon anyway, and from a practical point of view, it makes good sense, for if no improvements have happened by then in terms of the coronavirus, I have a hard time seeing these pulse levels being maintained. 4. From late April and on, we have a big red Ichimoku Kumo cloud casting its heavy shadow in the 0.5 and 618 fib levels as well, thus further strengthening the resistance. 5. On the 18th of March, we had a confirmed death cross on the daily chart. The practical impact of those crosses is that the price statistically tests the EMA 200 after about 50 bars on the same time frame. On the daily chart, that would mean that we could expect a test of the EMA 200 roughly sometime in late May. If this test of the EMA 200 were to be rejected, it would be a very bearish sign that things will continue downwards. An example of this is the death cross of September 2015, upon which the price tested the EMA 200 45 and 60 days respectively. Both times the price was rejected. 2 months later, the index had reclined by 20%, and this was during a temporary recline in a bull market. Imagine what the drop might be in a confirmed recession, like now. Now, if this potential EMA 200 test were to coincide with a Fibonacci, especially the 0.5 and 618, or any other significant level of resistance, it could on its own quickly turn into a shorting power play. Given all this, from a short-term perspective, I do expect a test to the upside. But here's the thing, unless any positive corona news of game-changing significance surface within a couple of months, one technical brick after the other will pile up to create a solid medieval-style brick ceiling above. One that will provide quite a juicy risk-to-reward swing trade short opportunity should the price test those levels. For without news, I cannot see how the market can have fuel enough to break above these clusters of resistance. It would play out so beautifully. Putting the pieces together, here is how I will play it. Personally, I hope we get a false outbreak to the downside from the bear flag and onto the 1240 area upon which I will go long with decent leverage. If we were to break out upwards, on the other hand, I will wait until we reach one of the Fibonacci levels before laddering in shorts, as an outbreak upwards may very well turn into a false one due to the volatility and unpredictable times at hand. Hence, given the volatility and risk of false outbreaks, going long on a northbound outbreak from the bear flag would be a very poor risk to reward play, one that I will stay away from myself. To sum it all up, unless we get some really nasty news on the coronavirus soon, I don't see how we are technically ready to break below 1240 just yet. If we were to, however, especially with heavy trading volumes, that would be one hell of a bearish sign, which I personally would take as a warning of what lays ahead. If else, I'm prepared to go long at 1240, ideally from a false bear flag outbreak, in which case I will place a heavier position with more leverage. If prices do go up, which they technically most likely will, however temporary, I will not go long unless prices retest the 1240 area. Until proven otherwise, I will use every 1240 touch as a long position opportunity. However, for every bounce, I will decrease my position size and leverage and lower each target respectively. A soon-to-come move to the upside would hence be likely regardless, and something I do expect to happen. If we were to get an upwards outbreak from the bear flag, however, I would not hop onto it, since it could very well turn on us at any given time and prove to be a false outbreak as well. Things are just too volatile, and such a position would offer too poor of a risk-to-reward ratio. In such instance, I will rather be looking at shorting at resistance levels. An initial smaller position with less leverage at the resistance coinciding with the 0.5 Fibonacci, and then ladder in a heavier position with more leverage at the 618. And in time, the more technical indicators that cluster at either resistance level, as in the EMA 50 or 200 and the red Ichimoku Kumo, the heavier a position I will be looking at taking. For if several or all of these resistances were to coincide, only a coronavirus vaccine or some other incredibly bullish news would have the power to push through. Short positions like these may prove to be the best risk-to-reward opportunity I have yet to see on an index level. That was all. Thank you and goodbye.